Hey, good afternoon to another fabulous day here in the Coachella Valley. We're back to normal. I don't see a cloud in the sky as I look out of the studio windows, and it's gorgeous outside. And while it's cloudy, or excuse me, while it's sunny outside, we're going to bring in, there's a guy out there in the internet. He's called Mr. Wonderful. And I think our host, which is Art Alvarez, he is Mr. Wonderful because he's always bringing news that kind of squares us up and keeps us on track. And in this case, it's all about mortgages. So let's bring him in. Hello, Mr. Wonderful. How are you today?
Hi, Jeff. How are you?
I'm
I wish I
great.
had
I'm
Mr.
great.
Wonderful's bank account.
Geez, yeah. But yeah, Kevin O'Leary's a little, I don't know if he's a love hate. I think that's why he's Mr. Wonderful. We don't know if we love him or hate him. I guess it just depends on the time in the day, right?
I think you're right about that. Yep.
So what's going on in the world of mortgages? We've got a lot of activity, ups and downs, and all kinds of things.
Yeah, I mean, activity's gotten a little better, but we're back to hand wringing about rates. Um, media has proclaimed we're back in the sevens, which actually is not really true, but we'll get into that. So.
Well, hey, I'm going to turn this over to you because I was a little late getting started. As I said, I got sucked into an IT tech rabbit hole before we get started, so I apologize. But before I go, I just want to mention, if you're just catching on here, if you have a question with Art, because this is the place where if you come and you have a question, Art will answer that for you. But just put it in the comments. I'll put it on screen. And if you're watching this recorded, just make sure to put it in the comments, and Art will follow up afterwards. With that, Art, I'm going to turn this over to you. Have a great.
Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. I'm Art Alvarez at MortgageWorks, where we have the answers and they're on the house. Let's get right into what's going on with the bond market and interest rates. As I mentioned to Jeff, the media, I think the public is sort of wringing their hands again because, well, rates are kind of climbing back up. We hit a low point late December, right after Christmas. And since then, that was back when the 10-year Treasury bond yield was about 382. It's much higher now. There's our rate grid. This was updated this morning, so this reflects the current rates, rate indications, I like to call them, as to what's possible with both conventional FHA, VA, jumbo, as well as equity loans, home equity lines of credit, and fixed rate seconds. So we are still in the sixes. Now, granted, we've kind of creeped up into the mid to high sixes on conventional. FHA, VA is broke through the 6% barrier, but still just barely over at about 6.1. So not, historically terrible, but definitely the enthusiasm for a bunch of rate cuts coming has subsided quite a bit. In fact, Jeff's going to pull up the 10-year Treasury bond chart, and you can see how the movement has been, pretty elevated the last 5 days. It was only last Friday when we got, down there under or close to 420, and it's been pretty much 4.25, 425 to 435 cents. And so it's really strange because we had such optimism, again, late December, right after the last Fed meeting, when it was perceived that the Fed was done with rate cuts and we're going to start dropping the Fed funds rate and start doing so aggressively. Well, you know what? That narrative has changed. That was then, and this is now. So why the change? Why the change in perception and expectation as to rates? Well, this week, the primary trigger, I think, was the release of the Fed minutes. Now, the Fed minutes are the written, basically the written minutes of their last Federal Open Market Committee meeting, which again was in December, when at that time, right after the meeting, the press conference led the market to believe that the Fed had pretty much got to where they were going to stop raising the Fed funds rate and would have multiple reductions in the Fed funds rate this year. Well, as it turns out, with the minutes being released this week, a whole different perception, a whole different scenario has been identified. And now, to put it in a summary fashion, as the bullet points suggest, they're more worried about cutting rates too fast than moving too slow. So the Fed is definitely going to be biased toward going slow with rate reductions. So at one point, late December, there was talk about 6 reductions in the Fed funds rate in 2024. Well, now the Fed funds future market has changed to where the predictions now is we won't even see a cut in the Fed funds rate until June. That's 4 months away. So it looks like, as the slide at the bottom says, it looks like we're going to be looking at rates higher for longer. Now, that being said, there's also other news out there that would seem to run counter to this narrative. Wells Fargo, for example, believes that the job market is weaker than it looks. And they're predicting that steep rate cuts will be coming this year. In fact, they're predicting the Fed funds rate will be reduced by 1 to 1.25% in 2024. And if the typical adjustment is 0.25% increments at a time, that could still be 4 to 5 rate cuts this year. So that kind of goes against the current narrative that it's not going to be that strong and that frequent. But the underlying point with Wells Fargo's take on rates is really, if you think about it, it's all about the job market. The labor market is really probably the biggest factor as to where rates are going to go. And the problem has been a lot of the data points for jobs, the labor market, have been pretty strong. Wells Fargo is skeptical, though, and that's why they're suggesting the jobs market's not as strong as it looks, and that's why they're predicting these rates to start coming down. And as it relates to recessions and the labor market, because there's still some folks out there predicting a recession, they're in the minority now, but the 2-year Treasury bond yield is still higher than the 10-year, and that's a reason why we're probably still potentially going to see a recession. But more importantly, I heard an interesting comment or sort of a rule that a particular financial market pundit threw out that I really kind of caught my attention. I thought it was a pretty good way to look at this. It's the 4 and 4 rule. The suggestion being that what to look out for in terms of a recession coming is the 4 and 4 rule, meaning unemployment rate gets over 4% and real wage growth drops below 4%. And we're really close to both of these right now. The unemployment rate is in the high 3s. Wage growth has been higher. It looks like it's starting to slip a little bit. And if wage growth goes under 4%, then we're essentially at zero wage growth or even negative wage growth when you take into account current rate of inflation, which is still running in the 3 to 4% range. So overall, therefore, keep an eye on these two data points, unemployment rate and wage growth. If we see unemployment creep up over 4, we see wage growth drop, start to trend down below 4%. That's probably a pretty good indicator we could, in fact, still see a recession despite the strong data points we've been seeing up till now. So again, we're not in the 7s. We are elevated. We're in the mid to high 6s conventional, very low 6s on FHA, VA. So if you're hearing 7% or you're contemplating getting a loan and being quoted 7%, give us a call. I think we can show you some better numbers than what you're hearing. With that, I want to go into another article that caught my attention, and it was in Yahoo Finance, and it was just a couple of days ago. It was on February 20th, and the headline is what caught my attention. The headline reads, and Jeff's pulling it up here: "A popular incentive for home buyers is here to stay, for now." Now, I'm going to fully admit right now, when I saw this, I feel like I've been vindicated. And what do I mean by that? Well, if you've been watching the show before, I've been talking a lot about using financing and making offers on houses, getting a seller credit and using that and applying it towards your financing to improve your terms, in particular, buy downs. So when I saw this article, I had to read it, and I had a feeling I knew what it was addressing. And the article starts out with more of a question like, is the housing market headed for a recovery? And I put a question mark there because, that's still more or less believed to be the case, but the recent uptick in rates is causing some concern about how soon that recovery will be. And given the assumption that the housing market is starting to head toward recovery, the proposition was, is it time for home builders to pull back on the popular mortgage rate buy down incentive? So that's the point here. This article underscores what has been a very popular incentive for home buyers, but primarily on new homes, and that is mortgage rate buy downs, in particular temporary buy downs. So the writer of this article was really kind of posing the question of, well, if the housing market's improving, do the home builders really need to still offer those kind of incentives? The reason why she would question that is because for the home builders, yes, offering temporary buy downs or even permanent rate buy downs, those kind of financial incentives does put a squeeze on the builders' margins, even though it has shown very clearly to boost their sales, or at least to maintain their sales rate in what otherwise has been a pretty negative market. And what really caught my attention was the quotes from a couple of the CEOs. D.R. Horton CEO, for example, says, "We have no plans to stop utilizing buy down incentives." I mean, he was very straightforward about it. They're going to continue to do that. But another comment he made in that regard really caught my attention, which is stay competitive to not only the new home market, but especially the resale market. So here you have the CEO of a major national home builder, who's, by the way, very active in my market here in the Coachella Valley, declaring they are going to stop. They are not going to stop using buy down incentives. They're going to continue to do that. And in particular, they're doing that with a focus on maintaining a competitive edge to the resale markets. That's, I think, a very important but subtle point. I've said for a long time, and on the recent program we did on temporary buy downs, when I have that online seminar, if you will, I made a point of suggesting, particularly to real estate agents, understand that home builders are your competition. Well, right from the horse's mouth, CEO of D.R. Horton basically confirmed that. Part of the reason the home builders offer temporary buy down incentives is to boost their sales vis-a-vis the resale market. And we've seen data to suggest that the home building segment of the marketplace has seen a better sales rate than existing home sales. These popular temporary buy down incentives are a key reason why. The Lennar CEO, same thing. They are going to continue to offer these, even if there is a belief and some signs of a housing market recovery. They're trying to, as he says, drive consistent pace with lower cost mortgage buy downs. And this, again, all underscores what I've said multiple times. Home builders historically have offered incentives to sell homes. Sometimes they just offer straight price reductions. Sometimes it's closing cost credits. Sometimes it's closing cost credits and the buy downs, or a combination thereof, or sometimes incentive for upgrades. The point is, new home builders have always been very good about offering incentives to get their homes sold. The resale markets, not so much. That's something I'm trying to change, and all I can do is keep talking about it. If you're going to buy a home, consider in your offer getting seller credits to apply towards your financing. If you're a seller and your home is maybe on the market a bit long and you haven't gotten the offers, don't drop your price, offer some incentives for the buyer's benefit and give them a reason to look at your house over others and get that home sold to them. Sellers can do that, and it's a much better way to do it than just dropping your price. So again, I wanted to talk about this article in part because I feel like it vindicates my message that I've been saying consistently, and I'm going to continue to say it because, in fact, recently, in the last couple of weeks, I've got multiple purchase transactions now in process involving 3-2-1 buy downs specifically. So it's an effective tool. We're doing it now. We've got real case examples, and I would encourage all of you who are on the sidelines about buying a home to take a look at that option. Give me a call. I'd be happy to spend some time with you to show you how it works. So I am hereby vindicated. We'll go ahead and move on now to the next topic we want to talk about. And this one is something that I wanted to add to today's program because I just went through this discussion actually with a new home buyer on a transaction we just started a couple of days ago. And so here's the dilemma. So you've applied for a mortgage. Now the big decision, to lock or not to lock the rate. In all seriousness, this is an important juncture, an important part of the application process when you're getting a mortgage, particularly if you're buying a home. So I wanted to kind of cover this topic and talk a little bit about the psychology and what I think about what's the best way to approach it. First of all, as I've said before, understand that mortgage rates, understand the relationship between mortgage rates and the financial markets. Mortgage rates are very much affected by what's going on in the financial markets, in particular the bond market. Why? Because most mortgages in this country end up being collateral for bonds. For FHA, VA loans, they are typically pooled together and serve as collateral for what's called Ginnie Mae bonds, bonds issued by the Government National Mortgage Association. Conventional loans, Fannie Mae, Freddie Mac loans, Those will serve as collateral for what they call MBS, mortgage-backed securities. So as a consequence, understand that mortgage rates are very much dependent on the financial market, in particular, the bond market. And that's why, as I always point out, when it comes to mortgage rates, which I prefer to call mortgage pricing, which involves both the rate and the discount cost. Discount cost is another fancy term for points, either points, no points, or a lender credit. Mortgage pricing, because it is so interrelated to the financial markets, mortgage pricing can change daily and intraday, during the day, just like the stock market. So that's important to know. So if you're checking around getting quotes from lenders, understand that any quote you start talking about, that could change in an instant at any time based on what happens in the marketplace. Remember on the first slide where I talked about on financial markets, they respond to stimuli with reptilian-like minds. Well, that's why mortgage pricing, just like the stock market, can jump around up and down every day and during the day and from week to week because of reacting to certain data points. And so it can make it somewhat volatile at times. I always say that a rate lock decision is an emotional one. Some buyers, some borrowers, they can get very emotional and worried about locking in the rate, worrying about are they locking at the wrong time or the right time, worrying that if they do lock, what if rates get better? And so, you have to look at yourself and understand where you're at in terms of that risk spectrum. If you're really risk averse, locking in right away is probably the best bet for sure. If you're more risk tolerant and if you have some reason to believe that the market's going to go a different direction, you might think it's worthwhile to not lock and see what happens. And by the way, the borrower's approach with this decision is determinant or dependent on the current rate environment. In other words, in 2020, 2021, rates were low. They had been falling. They were still falling. And so during that period, when we had a tremendous number of refis, I would encounter a fair amount of homeowners who would want to apply for a refi. A lot of times it's to lower their rate. And yet they kind of got caught up in the enthusiasm and the jubilation that rates had fallen so low and might continue to go lower. And they would more often choose to let's get this refi started, but I'm not going to lock because I think it's going to get even better still. In a current environment we've had now and for the last really year, 18 months, it's a different dynamic. With rates trending upwards, there is very few folks who want to take that gamble and not lock the rate at application. So again, a borrower's approach to the rate lock decision very much depends on the rate environment at the time. And understand that if you don't lock, you are undertaking market risk. And when you don't lock, and we've started a transaction, we call that floating. So if you choose to float the rate when you start your transaction, whether it's a refi or a purchase, understand you're at market risk immediately and continually until you lock that rate. So just understand that. I think most people do. But there are some folks out there who are willing to take that risk. They think they're smarter than the average pundit or observer of financial markets, and they think they have a reason to know where rates are going to go. That's fine. Just understand you could suffer the consequences if you're wrong. I always say lock the rate at application, that it's always the best thing to do. Now, why do I say that? Well, number one, it protects you from any higher rates that could occur during the loan process. I mean, once you've got a transaction in place, particularly on a purchase, it's usually got a time limit. It's a 30-day escrow, 45, maybe 60. But the point is, you've now started your process. And I think it's best to lock in right away. Why? Because you're protecting yourself from rates getting worse during your loan process. And again, that could be 30 to 60 days. Why would you, take the risk of that kind of exposure to the market when you can at least lock in a ceiling, lock in the worst case rate you're going to experience if you do it right at application? And part of the reason I say you should do that is because you have the opportunity with virtually any lender out there now. There is the ability to renegotiate your rate lock. It usually requires a certain minimum amount of improvement in the rates over what you locked at. There is a fee involved. It's typically 0.5% of your loan amount, but that's pretty reasonable, actually. And so the idea is understand that even if you lock at application, don't get too worried if rates do improve after you've locked and before your deal's closed. you will have the opportunity to renegotiate that rate lock under certain conditions and end up with a better rate than you locked at. And if you know that that's there to use, that's another reason. Why would you not lock at application? Protect yourself from the high side. You still have a chance on the low side of rates improve during your escrow process. And of course, once you get through all that and you close your loan, understand that even if you ended up locking your deal and closing your deal at the high point of rates, like right now here in late February versus last week of December when rates are lower, well, yeah, you missed that particular opportunity, but you wouldn't have known that in advance. And at least now you're locked in. You've got a probably fixed rate loan with the rate fixed for the entire loan term. You still have that refi window. That is going to come. We don't know if it's going to be a year. It might be two, might be more than that. But I do think in the next year, 2, 3 at the most, rates are going to fall and you'll still have that refi opportunity. Now, there are some exceptions. If you're buying a brand new home that's under construction, and in some cases that can be 4, 6, 9, even a year, 12 months. There are long-term rate locks available, but they get a little pricier, and especially the longer out that you want to lock for. So in a lot of cases, when you're going new construction, it's not always the best to try to do a long-term rate lock. It's almost better to just float with the market and at least get closer to completion before you do a rate lock, so you can at least do a shorter term. And then available lock periods on some programs just don't lend themselves to being able to lock an application. For example, many non-QM programs, non-qualified mortgage programs, those are the ones that don't meet standard Fannie Mae, Freddie Mac, FHA, VA guidelines for qualifying. Many of those programs don't even allow you to lock the rate until you've been underwritten and approved and the file's essentially ready for closing. So you don't even have that opportunity to lock the rate. Although the non-QM product, as a rule, isn't quite as volatile and not quite as subject to the daily changes or weekly changes in rates as the conforming mortgage market is. So just understand that with some of these programs, non-QM in particular, you either can't lock until you're fully underwritten and approved, or you can only lock for pretty short periods of time. Many of them only will do 30 days. Some will go to 45. So if you have a 60-day escrow, you may be floating for a period of time and subject to the market, even if you don't want to. By nature of the type of loan program you need to complete your transaction, you may not have any other choice. So that's my take on when to lock or not. I say lock at application. You still have these other benefits to take advantage of lower rate opportunities in the future. So why not? Just lock it, be done with it. You can sleep at night and then just hope that things improve and then take advantage of that. So that's my take on locking in a rate. Now I want to go ahead and Jeff's going to bring in a question that we have this week that actually is pretty interesting because I just went through this with a borrower, so I thought it would be a good one to cover. And here it is. It's regarding appraisal fees. One of the things I've mentioned about Mortgage Works for quite some time in our history, actually, since we started in 1997. As a policy, we have never, ever had a policy where we collected an upfront payment for appraisal and credit report. Some lenders just call it a good faith deposit for services to be ordered. We have never done that. We've always kind of worked with the honor system with our borrowers and let them know that we're going to, when we order the appraisal, we're going to pay for it up front and then not get reimbursed until we close the loan as part of their closing costs. So I had this question from a viewer that I wanted to cover because he said a friend of his had applied for a cash out refinance mortgage and was led to believe he was approved. Early in the process, he was asked to provide a credit card to pay for an appraisal at time of order. After that, he was advised his application was denied. So can he get his money back for the appraisal? Well, interesting question. Again, I just went through this, so let me tell you how that happened or how it went. I had pre-qualified a homeowner actually for a refi. Homeowner was self-employed. And so the first step was, of course, to get his tax returns and determine if he could qualify based on conforming guidelines, calculate a qualifying income from the tax returns and see if his debt ratio would be acceptable for the program he desired. So after going through that process, I determined that he was not able to qualify using his tax returns. So I suggested a bank statement program. Again, that's one of those non-QM programs where we qualify typically a self-employed borrower by taking their bank statement deposit activity on their business statements for the last 12 or 24 months, calculate a monthly average after taking an expense ratio and use that as their qualifying income to calculate the debt ratio. This type of loan is very effective for self-employed borrowers where their tax returns don't support qualifying for conforming guidelines. You do end up with a little bit higher rate, but not too much higher, and so it's a good alternative. So anyway, I got this borrower approved on the bank statement program. A couple of days later, he calls me and he says, "Sorry, but I'm not going to pursue your loan. I checked with another lender, and I'll tell you who it was. It was Rocket Mortgage, and he checked with them, and they advised him that he was approved, that he could get it was a jumbo loan, but he could qualify based on conforming terms, and they were offering him a rate about 0.5% lower than what I had offered on this bank statement program. Well, I was a little bit taken back by that. Seemed a little bit not believable. I've been around a while. I've read a lot of tax returns for borrowers. I know how to calculate qualifying income from them. And I just felt there could be no way that Rocket Mortgage, I know they're a big retail nationwide lender, but I felt there could be no way that they would, using the same tax returns, approve this borrower. But, I had to go with it. I couldn't challenge it. I said, well, thank you for letting me know. I'll stick around in case things change. You know where to find me. Well, guess what? About 4 days later, he calls me back and he says they declined him. Worse, after being told he was approved, they, of course, immediately demanded that he provide some money. He gave him $500 for the appraisal. And when he called me, that 4 days later to tell me they did a 180 and said he was declined, he also told me the appraisal was already done. And so, of course, he came back to me and we were able to, kind of reopen his file and keep going, and we got that deal closed. Now, in terms of answering this question, can he get his money back for the appraisal that he ordered through, in this case, Rocket Mortgage? Well, yes and no. The way it works when you pay these kind of upfront deposits or the upfront appraisal fee, typically the lender is going to tell you it's non-refundable. You're not going to get it back. Now, in his case, he was fortunate in that we were able to arrange a transfer of the appraisal from Rocket to the lender we placed the loan with, so he didn't have to pay for a second appraisal. So that's part of the answer to this question. If you are able to get your loan done elsewhere after being declined, then you can essentially get your money back by having that appraisal transferred from the first lender to the other lender who can do your loan. But in a lot of cases, when you get declined after paying for the appraisal, you can't get approved anywhere. And so when that happens, you're out the money. What's the lesson to be learned here? Well, what I always say, and this would be a particular thing to think about regarding a refinance loan, because with a refinance loan, you don't have the time constraints of a purchase transaction where you've got a seller involved and you have to meet deadlines. That doesn't mean you want to go slow in a refi, but you don't have that same time constraint. So when you're pursuing a refi with a lender, and after you've applied, if you've been told you're approved and they now want to get money from you to order that appraisal, I would suggest to you, do not do that. Tell them no, at least until they can present to you a written underwriting approval with conditions listed so that you know for sure you have an underwriting approval that you can bank on. In this case of my borrower who was told he was approved, he never got that. He was basically told by a representative who my belief is was sitting in a big room at a cubicle with a bunch of other representatives at cubicles. And the person who told him he was approved, that was nothing more than an opinion and wasn't backed up by an actual underwriting decision. So when you're doing a refi and you're and they're asking you to pay for the appraisal, don't pay for it. Tell them no. Tell them you don't want the appraisal ordered until your file's gone through formal underwriting. You've gotten a formal underwriting approval with specific conditions listed that you can review so you can make sure you can meet those conditions and actually get the loan. Once you get to that point, sure, go ahead and authorize them to order the appraisal and you can pay for it if they want you to. But remember, if you want to get a refi, you don't want to pay an appraisal fee up front, give us a call. We don't collect for it. We can get it from you at close. Okay, so that's a good question. There's your answer. Protect yourself when you're getting a refi. Don't don't pay for the out appraisal until you get that underwriting approval. And with that, we're going to go ahead and go to our closing question from last week. And that was a pretty good one. And of course, it came out because I've been talking so much about buy downs and seller credits. And so the question was, I often speak to negotiating seller concessions when making an offer on a home to enhance the purchase loan terms. Is there a limit on the amount of funds a seller can provide a buyer for financing concessions? Well, the answer is yes, there is a limit, which, by the way, there didn't used to be. Believe it or not, way, way back when I first got in the mortgage business in the early 80s, 1982, there were no seller concession limitations in place back in those days. And that ended up becoming problematic because in periods when we had, double-digit, high teens interest rates, you would see, for example, home builders who would offer below-market rate buy-downs that would cost them literally 15 points, and they would basically just pack that cost into the price of their home. Well, that ended up creating some problems with valuations of homes because of the excess incentives. So over time, the federal mortgage agencies came up with some guidelines. So here they are. With Fannie and Freddie, what, again, we call conforming guidelines. For a primary or second home, if you're purchasing a primary or second home, and if you're putting less than 10% down, the seller credit you can get from the credit you can get from the seller is 3% of the transaction price, the purchase price. 3% of the purchase price. That's the maximum seller concession you can get if you're putting less than 10% down. If you're putting at least 10% down, but less than 25% down, then that increases to 6%. And then if you put 25% down or more, it can be 9%. So obviously, if you're putting at least 10% down to 25% down, you can extract a very substantial amount of seller credit and then use that to greatly enhance your loan terms, as long as all that money is used for acceptable things like temporary buy downs and actual closing costs. If your transaction involves your purchase of a rental property, you can still get a seller credit, a seller incentive. These are actually technically called interested party contributions. But if it's an investment property transaction, the seller credit you can get is limited to 2% of the purchase price. And of course, with these percentages, remember, they're calculated off the purchase price. But if you're dealing with a situation where the borrower's loan is substantially below the purchase price, meaning they're putting a large down payment, keep in mind that some of these credits that you get are going to turn out to be a lot more dollars when compared to the loan amount the borrower wants, because they are calculated off the sales price, not the loan amount. Jumbo loans generally follow the same as Fannie Freddie. FHA and USDA loans. Now, these are interesting. FHA only requires a 3.5% down payment, and you don't have to be a first-time home buyer. USDA loans allow 100% loan to value or zero down payment if the property is in a rural area. With both of these programs, despite only a 3.5% to zero down, you can get a seller concession, a seller credit up to 6% of your purchase price. So that's a good amount of money, can really be used effectively to enhance your financing terms. And then, of course, with VA, 100% financing, VA, a pretty good credit amount allowed, 4% of the price on a VA loan with no down payment. So there's your seller credit limits. That's a good question. Keep these in mind at any point when you're talking about or considering using a negotiating style of trying to get a seller credit to be applied towards your financing terms. You just have to make sure you keep these in mind. So with that, I'm going to go ahead and finish up with our closing question for next week. And this is an interesting one. We do encounter this from time to time, although I'd say less so than we used to. I get an auto allowance as part of my employment compensation package. Can this be used as part of my qualifying income when qualifying for a mortgage? So good question. Stay tuned for the answer to that at next week's Mortgage Minute, where I'll have the answer and it'll be on the house. Jeff, back to you.
Art, great information. I love the fact that you have been vindicated, that seller concessions and using temporary buy downs is not something that you were the only one saying it, although you were the only one saying it. And you have absolutely been like a bulldozer going through the forest. You're creating a whole new path. And I'm glad to hear that people are finally tagging on and saying, hey, this guy, Art Alvarez with Mortgage Work, he is the guy I want to go see to do my loan and really capitalize on some low rates, knowing that, hey, the future does hold potential for lower rates for me in the future, and I can just refinance. So I think what do you call that when you said, hey, you own it at both ends? What do you say about that?
Well, I mean, I call it's kind of like a one-sided bet. I mean, the whole idea
Mm,
here, like with these buy downs, is even now with all the hand wringing and the rates are back up and the media says we're at 7% again. Well, again, not quite true, but even this purchase deal that we just started here 2 days ago, um, borrower is putting 10% down, and I shared with the buyer and her agent, you should look at using a 3-2-1 buy down. So we've opened escrow. 3-2-1 buy down is part of the transaction. The borrower's got a note rate of 6.624, 6 5/8. Her first year payment or first year rate is going to be 3 5/8.
wow.
Second year 4 5/8, third year 5 5/8, and so it's not until 4 years from now, or actually 3 years from now, where she will even encounter the actual payment on that note rate. I would argue probabilities are good to excellent that in this next 3-year period, before that note rate is ever actually arrived at, she will have an opportunity to refi. So that, the whole idea here is you've capped your worst case note rate. You
Mm.
still get to take advantage of getting a rate starting in the threes your first year, and then you still have that opportunity to refi during that 3-year window. I mean, that's just a no-brainer. Now, of course, it's not a cakewalk to just get the amount of concession you need out of a seller to pay for all that. But I would argue there's a lot more houses on the market where there is that opportunity than there was before. And I'm starting to see more and more buyers realize that and try it, and it's working.
Yeah, I think it's a great idea, and I think you mentioned before that the average uh, seller price concession was between 3 and 5%,
Yeah,
and
it's 3 to 5 or 2 to 5%. I mean, the sale price under list price, it's never at 100. It's always a little bit below that. It was, of course, very little below that in 2020 and 2021. It's more so now, which is why the conditions are so much better for taking that shot. And particularly when you're worrying about, oh my gosh, we're approaching 7%. Well, here's a way to insulate you from that to a pretty significant degree.
yeah. For those of you who are wondering, hey, what is this temporary buy down? I put in the comments the link to the webinar that Art recorded a couple weeks ago, and it goes through step by step exactly how you can use that and how that effectively changes your monthly payments for the first 3 years of your loan. And you can save a lot of money and get not only on your loan, but also the fact that you're locking in today's prices on the home. Because Art, I don't think we're going to see the home prices go backwards, are we?
I don't think so. In fact, it's really interesting you said that. Yeah, no, I don't think home prices are going to fall when rates fall. I think the opposite, actually. I think when rates fall, there's so much buyer demand that even with increased inventory of homeowners who say, okay, rates have fallen, now we can sell and maybe get a reasonable rate on our next home purchase.
Mm,
That increase in inventory is going to be overwhelmed by the buyer demand that's sitting there waiting. So I think home prices are going to go up when rates fall, not go down. And I was at a presentation this morning with a group of realtors, and one of them had a great saying that I actually asked him if I could use, which was date the rate, marry the home. And in my way of thinking, that's a perfect one-liner for why a temporary rate buy down is a great option. Date the rate, 3-year date, right? Marry the home. So you get into home ownership now. So you've married the home, but you're dating the rate for 3 years. That's a
I, li-
no-brainer
I
again.
like it. I like
Yeah.
it. Again, the link is in the comments, and that's on YouTube and on Facebook, and you can just watch that. There's no charge, no link in. You're just going to watch that, and it's about, I think it's about 30 minutes, and you're very much in detail, and there's so much good information there. You can walk away having a clear understanding. Hey, is this right for me or not? And it could close the gap on you thinking, oh, I have to wait. It could actually put you in the driver's seat. So, Art, thanks for doing that. Sure. If you need more information, again, Art is with Mortgage Works. His name is Art Alvarez, 760-883-5700, or his cell phone, 714-612-9035. No, that was not a meteor you saw over Arizona. That was his flashing red phone. He was taking incoming phone calls. That's a website, mwloan.com. You can always go there and check out what's going on as far as the rate. You saw that at the beginning. And also, there's a great resource of tools just below that you might want to check out. And of course, Art's always available by his email at art@mwloan.com. Art, great information. I look forward to hearing how things are going next week. And, if you need to get a hold of Art, 883, that's 760-883-5700, anywhere in the state of California. He is licensed to help you close your deal. Art, have a great week.
Hey, thanks, Jeff. Thank you, everyone. Thanks for watching and listening this week's Mortgage Minute. Stay tuned next week when we'll have some more good information for you on the mortgage market. Don't fret about rates. We're going to be okay. They're up a little bit, but we'll see what happens next week. Thank you. Take care.